Let's just quickly check the sound quality. Testing. I don't know. Testing. Okay. I think it sounds good on my end. Okay. Boom. Okay, let me know, anybody who's watching, if something is messed up with the stream, if the sound is out of whack, or if it sounds good, let me know. As far as I can tell, everything looks like it's in order. And we're just going to chill for a little bit while we wait for people to roll in. Starting the stream a little bit earlier than usual. Trying to get done early because it is New Year's Eve after all. So I want to get it done. Okay. All right, I think we're good. So, hey, Hokage. Good to see you, man. Nice coincidence for New Year's Eve. Yeah, that's right. And speaking of which, we're going to celebrate our first full year of public YouTube portfolio performance. I've got it pulled up right here. We can officially say that after 1 year of our public YouTube investing that we have beat the S&P 500 by about 5%. So I'm happy with that, especially since, you know, we didn't just pick one or two companies. We picked, how many? How many did we pick? 46 different companies. We didn't hit 52 because there were a few weeks where we doubled down. And there were a few weeks where the company we tried to invest in was not covered on M1 Finance. But if we, let's go back to our benchmarks here. Okay. Always got to add, I wish this was a default, but we got to add the S&P back in there. Nano Wealth Guy, holy crap, 46 stocks. Yep. Yep. We went a little bit overboard, you know, so the theme of this public YouTube portfolio is we try to pick a different stock every week. Typically, we invest $100 every week in a different company. Now, I did break that rule. It's more of a guideline. There were some weeks where I would double down on an existing holding that I had because it went down in value and I still considered it to be undervalued. And there were a few weeks where I actually invested in 2 stocks. So anyway, we were a little bit all over the place. But yeah, 22.5%, barely edging out Vanguard, Total World, beating iShares Core Growth, beating S&P 500. So very happy with the performance. And if you've been a longtime viewer of the channel, you may remember that I used to start off my videos by enjoying a glass of bourbon, a small taste. We only drink responsibly here in moderation. And I'm going to do that for our 1 year anniversary. And my bourbon of choice, this is my favorite bourbon, if you care. This is Garrison Brothers. It's a Texas bourbon. It is first, it spends 4 years in toasted and charred white American oak barrels, developing caramel, raspberry, cinnamon, and chocolate notes. And then the bourbon spends 2 more years finishing in port casks imported from Portugal. So port is a dessert wine. So it adds a sweet, jammy kind of grape flavor. Very good bourbon. This is my favorite. This is my personal favorite bourbon currently. Look at that. Very good. So cheers to the new year. We're doing it a little bit early, but I am not going to be streaming at midnight. I'm going to be hanging out with friends, and I hope you guys will too. So I hope you had a good year. Okay, let's get this show on the road. So this week, I'm looking at bank stocks, regional banks, small cap, value. All right. Where did I find these banks? I've been using a particular stock screener quite a bit lately. So we've got market cap at set to small, between 300 million and 2 billion price to book ratio under 1, any industry, a net cash position, meaning the cash that they have on hand exceeds their total debt. And finally, I just want to see revenue growth on average over the last 5 years. So I've got this filtered by banks. Lots of banks came up with this search criteria. I went through every single one of these, and there were 2 standouts. One of them, I was not able to invest with M1 Finance, and so the other one won the tiebreaker because it was able to invest on M1, and that is PPAC Gladstone Financial Corporation. So the way that I have my initial screener, and then the way I do a quick check on every single one of these companies is I put them into my automated discount free cash flow spreadsheet. So all I have to do is type in the ticker. I then set the free cash flow margin to be equal to their average historical free cash flow margin over the last 5 years. And then I assume just 2% revenue growth, because remember, I'm only filtering by companies that have shown positive revenue growth over the last 5 years. So I'm just assuming that they grow by at least 2% in years 1 through 5, by 2% in years 6 through 10, and by 2% into perpetuity. And then I have my discount rate. This is my desired return annually every single year. I have 8.25%. That's my desired return. The way I came up with that is I use the risk-free rate, which is the U.S. Treasury 10-year. That's about 4.12%. And then the equity risk premium is about 4.12%. And that's just the additional return that you desire on top of the risk-free rate, because stocks are certainly not zero risk. So this is my minimum return. And given this set of assumptions, my projection right here, this automatically calculates this spreadsheet. It pulls in all the information from stockanalysis.com. That's this website right here. Before I go to the financials, it pulls in all this information going back 10 years, and it calculates the discounted future free cash flow valuation. So given this set of assumptions, I've got a projected stock price of $79.52. So that is astoundingly good, because that is a 186% upside. So at this point, so I did this quick check with every single company. This company and one other came back to be by far the best in terms of this just initial search. So now I'm going to take a closer look, and I'm going to bring down some of these assumptions to be more in line with reality. So, okay, first thing I want to look at is the past free cash flow margin. Over the last 5 years, they've averaged 33% of their revenue. They've been able to turn into free cash flow margin, but there's a few tweaks I want to make. So first of all, I always take away any stock compensation. In this case, this company it puts almost $0 into stock-based compensation, so that's not an issue. Sometimes I give credit for capital expenditures. If a certain percentage of their CapEx is geared towards growth and a certain percent is geared towards maintenance, I'll try to suss out the 2 different categories there and try to proportion them appropriately. In this case, I'm going to stay conservative. I'm just going to count all of their capital expenditures as maintenance. So none of that is being credited to free cash flow margin. So with that in mind, I see one standout year right here. So in 2022, they had 48% free cash flow margin. All of these other years were considerably lower, 21, 35, 31, and 28. So I'm going to assume that this was an outlier year, and I'm going to lower their free cash flow margin. In fact, I'm going to lower it all the way to their worst year. I'm going to assume that margins are contracting going forward, and their margins are just going to be 21%, in line with their COVID margins. So I'm going to make this a lot more conservative, 21% free cash flow margin. Given the lower margin and just a 2% growth rate, they're still insane. This is the My Projection tab, still a 96% upside. I'm projecting a $54 fair share price, even though their current share price is $27.85. So I've looked at the free cash flow margin. The next thing I want to look at is the revenue forecast. So there's a couple different ways I like to pull this information. Number one, I like to look at the historical revenue growth. Historically, this company has grown over the last 5 years at a 7% rate. So my 2% assumption is even more conservative than their past performance. The next way I like to look at revenue growth is, what do the analysts think about this company? So First stop is stockanalysis.com. They have a forecast tab, and the stock price forecasts are all very high. The analysts, do not think that the stock price is going to be as high as my spreadsheet is initially saying. They're giving a $35 fair share price. So still, that's a pretty nice upside, 27%. But what I'm more interested in is not their buy ratings. I like to scroll all the way down to their revenue growth projections. So over the next 3 years, or 2025 is almost over, but so 27% revenue growth in 2025, 16% in 2026, and basically 16% in 2027. So the analysts are saying double-digit revenue growth. So analysts are saying it's going to be accelerating. Let's see if there's some different analyst projections that I can look at. So another place I like to look is on Charles Schwab. Since I invest with Charles Schwab, I get access to certain analyst reports. This is the LSEG Stock Report Plus. They give a strong buy rating. 4 analysts are weighing in on this one. But if I scroll down, I can see their price targets are all very good. Their earnings per share projections are all going up. And their revenue projections are going up about 20% per year for 2025, and then another 20% for 2026. So all of the analysts that are making projections on this company, there's only 2 on this LSEG data and analytics, but that's a handful of analysts. They're all saying 21% revenue growth. So my assumption here, 2%, seems to be incredibly conservative. Now, the way I view this spreadsheet is I'm trying to show a scenario that I'm confident that the company will surpass. So I'm trying to create this base case scenario. And if I'm still happy with the returns on the base case, then I like to invest in the stock. So in this case, 2% revenue growth. The analysts strongly believe this is going to be surpassed, at least over the next 3 years. So I'm very happy with this initial assessment. Now, the final way that I like to look at revenue growth is I like to swap my thinking. So invert my thinking. Instead of thinking of the assumptions that I think are true and then looking at the resulting share price, I want to assume that the market has priced this company correctly and then see what assumptions make the current share price true. So let's start chipping away at this. So the first thing I want to do is lower the free cash flow margin even more. I want to cut it in half again. I'm going to make it 10%. With a 10% free cash flow margin, we've got 15% upside. Now let's drop the revenue growth rates to 0. Okay, with 0 revenue growth, I'm seeing a fair share price at 26.66. Current share price is 27.85. So this is roughly fair price. So this is one scenario that the market could be believing about this company, a much, much lower free cash flow margin and 0 growth. Now, maybe the market thinks that this company will be slightly more profitable. Let's go back to the 20% free cash flow margin. And then let's put in losing 5% revenue every single year into perpetuity. Oh, dang it. I'm botching this. -5. Damn it. There we go. Okay. So if they have their 20% free cash flow margin, which is still lower than their average over the past 5 years, and then they lose 5% of their revenue every year forever, so a shrinking company with depressed margins, the company is about fair price today. And when I say fair price, what that means to me is I should expect to get an 8% return per year every year. So in this scenario, I cannot believe that this company is going to be losing 5% revenue forever with a depressed free cash flow margin. So to me, already this is screaming, this company is a value pick. It is undervalued significantly, because if I put in the average assumption, so let's now use an average free cash flow margin. So 28, 31, 35, 21. Let's just average these 4 columns. Say it's about 30 on average. If we bump it up to their average free cash flow margin, excluding the one big outlier, and then we say that they are going to grow at the same pace that they've grown historically, which is 7%, even though the analysts think that it's going to be more like 20%. If we just say 7% growth over the next 5 years, 3% growth into perpetuity, and then a 5% growth rate for years 6 through 10, then we've got a my projection of $106 per share. So this company is just insanely undervalued in terms of free cash flow. Okay. So the next step is let's look at how they're actually spending their free cash flow. Let's dive into the financials of this company. What are they actually doing with all this cash that they're pulling in? So when I go to PPAC Gladstone Financial Corporation's financial statement here, go to their cash flow. Let's look. So the way operational cash flow is calculated is they start with the net income and then they add back in their non-cash expenses. So depreciation and amortization, it gets added back in. Let's see, provision for credit losses, this gets added back in. So whenever they're calculating this company's projected income for the year, they are assuming that there's going to be some credit losses. There's going to be some people that they loan money to that they don't get all their money back. So this cash gets added back in. And then there's decreases in increases and decreases in loans, accrued interest receivable, changes in other operating activities and other operating activities. And then we have our operating cash flow. Then to calculate free cash flow, you simply subtract the capital expenditures, and we have a free cash flow, if we scroll down here, of 54 million over the trailing 12 months, 63 million, 66 million, 115 million. So what are they doing with all this? I like to let's just look at the operating cash flow. So over the trailing 12 months, they had 70 million come in. They spent 15 million on capital expenditures. We're going to call that maintenance. They invested 60 million in securities. And then here's the big one right here, net decrease or increase in loans. So this company had, over the trailing 12 months, it had $724 million leave the company in terms of loans going out. So this is going to be just future growth for the company. This is a bank. You want to see more people taking out loans, and assuming they're doing their job and they're doing due diligence on the people taking out these loans, this money is going to come back to the bank in greater numbers in the future. This is going to be ideally a profitable investment. So this row right here is really indicative of how much this bank is going to be growing in the future. So what I'm seeing here is there's only 1 year where they had a decrease in their loans. If I scroll up, that was 2020. That was COVID. So they had a bad year during COVID. I can excuse that. But on either side of COVID, we have 300 million more in loans, 400 million more in loans, 233 more in loans. So their loan category is growing by hundreds of millions of dollars every year. And then over the trailing 12 months, they had their biggest year yet, $724 million. So they had roughly $800 million leave the company in terms of loans going out, more than cash came in for investing. So that's a good sign. They're investing in future growth. They're bringing in 70 million in cash flow. They had 800 million go out, and then they had 35 million debt repaid. So they are creating loan balances that is going to pay dividends into the future. So this is a growing bank, lots of free cash flow. They are buying back a little bit of stock and they're paying a little bit of dividends. What is their current dividend percentage? It is just 0.72%. So not a huge dividend, but in terms of their share price, they've got lots of cash coming in. So what I would expect to see is a growing dividend over time, maybe additional share buybacks, and more cash that they can put into improving their balance sheet. Okay, so let's look at their balance sheet. If we remember, one of my initial search criteria was I wanted to see a net cash position. Oh, come on, if I can click this. Okay, balance sheet. So if I go to all of the company's current assets, cash, investments in securities, mortgage-backed securities, they've got $879 million in total assets. They've got $609 in gross loans for a net loans of $5.95 billion. Okay. So their total assets, $7.4 billion. If I scroll down to their total liabilities, I can see that their total liabilities, $6.797 billion, which gives a shareholder equity of $642 million. So if we take all of their liabilities and subtract it from all their assets, we've got $642 million left over for the shareholders. If we compare that to their current market cap, Their current market cap. So this company is supposedly only worth $485 million. So the company's worth 485, even though we have equity in the company. Oops, back to the balance sheet. The shareholder equity is $642 million. So the price to book is less than 1. There's more equity than there is share price. I love to see that. And the company is increasing their free cash flow, increasing their revenues every year on average over the last 5 years. So everything about this company screams value. Big fan. This is the company I'm investing in. This is the last company actually that I'm investing in 2025. So unless this company somehow loses me more than $100, we will still remain positive going into 2026. If this company goes out of business after hours, then it might hurt our streak a little bit. But this is the last company of 2025. 2026. I'm going to be increasing the amount that we invest every single week. I'm going to move up to $250 so we can start to accelerate towards 10K. 10K has been my goal, my near-term goal for this public YouTube portfolio. Beat the S&P 500, acquire over 52 stocks, $10,000 invested, and like I said, beat the S&P 500. So those are my short-term goals. Once we hit 10,000, the next big goal, of course, will be 20,000. 50,000, 100,000. I'm excited to hit all these goals, and we will maybe very slowly increase the amount of money that we're investing every week. And I want to keep it, relatively low, something that's achievable for people to follow along if they want to invest the same amount and even compete. I would be really happy to see people posting their own portfolios, companies that they think that I'm overlooking that are also undervalued. And if you have any companies that you want me to look at live on stream that you think are seriously undervalued, I'm happy to give them a quick look live using my automated discounted free cash flow spreadsheet. So anyway, this is the company. Really excited to invest in PGC, and I'm also excited for 2026. Thanks for joining me in my last stream of the year. Once again, cheers. And we're going to sign out early today so everybody can get back to celebrating with family and friends. Nano Wealth Guy, thanks for tuning in. Hokage, as always, I'm always really happy that you tune in. And hope you guys enjoyed the first full year of public YouTube investing. I hope to see you both again in future videos. Good night. And Happy New Year, Hokage. See ya.